So we were discussing the market constraints the from phase different from phases in their production decision making or the production process. So next is our efficiency. So what kind of efficiencies we have? So we have technological efficiency and economic efficiency. So the technological efficiency uh, refers to the firm's ability when a firm produces a given level of output by using the least amount of input. So the keyword here is least amount of input. So if any firm is producing a good uh, without wasting much or by using the least amount of inputs, so the firm is technological efficient. So there may be different combinations of inputs so to produce a given level of output, but only one of them is technological uh, inefficient. So if it is possible to produce a given good by decreasing any one input holding all other input constant, then production is technologically efficient. On the other hand, we have economic efficiency. The economic efficiency refers to the ability of the firm when they produce a given level of output at the least cost. So here the keyword is the least cost. So if the firm is using the least cost method, so they are economically efficient, and it depends on the relative cost of capital and labor they use. So the difference between technological and economic efficiency is that the technological efficiency concerns the quantity of input used in production for a given level of output, whereas economic efficiency concerns the cost of the inputs used. And economically efficient production process also is a technological efficient process, because definitely if you are economically efficient means you are also technologically efficient, but the technological efficient process may not be the economically efficient process. Changes in the input price influence the value of the input but not the technological process for using them in production. So this is the difference between technological efficiency and economic efficiency. So what is the role of information and organization? So a firm organizes production by combining and coordinating productive resources using a mixture of two different systems. So the firms actually use these two methods to organize and maximize their profit, organize their production and maximize their profit. The one is command system and the other is incentive systems. In the command system, it uses a managerial hierarchy according to which the command passed down through the hierarchy and information feedback comes from the same hierarchical process. So these systems are a little rigid and can have many layers of specialized management. Definitely, if there is a hierarchical structure, so getting rapid decision is difficult because you need a lot of channels to pass on your method or any information you need to follow the hierarchy. On the other hand, an incentive system uses market-like mechanism to induce workers to perform in a way that maximizes the firm's profit. So, in other way, we can say that these two systems are basically. Uh, we also have a strategy that is called carrot and stick strategy. So the carrot is a kind of incentives, and the stick is the kind of command system. So some people motivate with incentives, but others may need some strict actions or the commands they need from the higher authorities. So the firms or organization basically use all these two methods to get efficiencies. Somehow they also mix the systems, and most firms use a mix of command and incentive systems to maximize their profit. because the use command when it is easy to monitor performance, or when a small deviation from the ideal performance is very costly, so they use command system at that time, because monitoring is difficult and it needs a lot of time and resources, so that's why they use the command system when monitoring is easy. But they use incentive system where monitoring performance is difficult or impossible or too costly to be worth doing. So in that case, they use incentive systems. So what is the principal agent problem? The principal agent problem, or the agency cost theory, it is the problem that the compensation rules the induce an agent to act in the best interest of principal. Basically, if you see the organizations or the big organizations, so there's a difference between the owners of the organizations and those who are managing the organization. So managers and the stakeholders. So there's a difference, or there's a rivalry between these two groups, or the incentives, because the managers, the theory says that the managers work for their own benefit, whereas the stakeholders or the shareholders of that firm, they need their benefits to be covered by their agent, in this case their managers. So the stockholder firm are the principals and the manager of the firm are their agent. So how we can cope with this principal agent problem? So there are, hypothetically, there are three ways of coping with the principal agent problems. Number one, ownership. You can offer them ownership, or some ownership. You can also give them incentive pay, or you can contract. You can do the contracts with them with the long-term contracts. So ownerships often offered to managers gives the manager an incentives to maximize the firm's profit, which is the goal of the owners or the principal. So it's a kind of profit sharing with the stockholders. So managers can be made partners in terms of their ownership, or they have some stocks of the firm. So definitely, uh, they will work for their own benefit, that will go through the benefit of the stockholders or the organization. So this is about ownership. Incentive pay links managers or workers straight to the firm's performance, and it helps align the managers and workers' interests with those of the owners or the principals. But to me, it is not a kind of very very effective way, because sometimes they evaluate, or the managers evaluate wrongly, and the incentive pay method won't work well. The third one is the long-term contracts. So you can tie the managers or workers in long-term rewards to the long-term performance of the firms. This method is, it encourages the agent work in the best long-term interest of the firm's owner or the principals. So what kind of organizations do we have? So we have three different type of organizations. So the first one is the proprietorship, the second one is partnership, and the third one is corporation. So the proprietorship or the sole proprietorship is off the cuff firms, or the firm with a single owner who has unlimited liability or legal responsibility for all debts incurred by the firm up to an amount equal to the entire wealth of the owner. So in this structure of the firm, the liability is, the whole liability comes on the shoulder of the owner. So it is a kind of unlimited liability in sole proprietorship. But the good thing is that the it is easy to form, and the taxation is a single taxation in sole proprietorship. So the proprietors also make management decisions and receive the firm's profit. It is also easy for them to take decisions without following formal hierarchy or whatever they say, it becomes a decision. And they are also they are able to get the profit well, and the profits are taxed the same as the owner's other income. So the second one is partnership. The partnership is from with two or more owners who have unlimited liability, and the partner must agree on a management structure and how to divide up the profits. So the profits from partnership are taxed as the personal income of the owners. So the third one is corporation. A corporation is owned by one or more stockholders with limited liability, which means the owners who have legal liability only for the initial value of their investment. It means the liability is shared in corporation. So if you have 500 shares of any firm, so your liability rests on the only 500 shares. So it is limited liability. So the personal wealth of the stockholder is not at risk if the firm goes bankrupt. Definitely the liability is shared. So it is not the responsibility or the whole responsibility of the stockholders if the firm gets bankrupt. Or the profit of corporation is twice. It means the corporation's profit is taxed twice. So this is a double taxation system in corporation. That is the drawback of corporation. Once as a corporate tax on firm's profit, then again as income tax paid by the stockholder receiving their after tax profit distributed as dividend. So this is the drawback of corporation, because it charges double taxes, or also the tax rate for the corporation is higher than the personal tax rate in most of the countries. What is the role of information acknowledgement? So the pros and cons of different type of firms. So each type of business organization has advantages and disadvantages. So let's see. So the proprietorship, it is easy to set up. So managerial decision making is simple. Profits are taxed only once. But bad decisions made by the managers are not subject to review, because the one and only sole proprietor and the owner's entire wealth is at stake in case of bankruptcy. So the firm dies with the owner. So the chances of growth are very limited in case of sole proprietorship. So the cost of capital and labor can be high, because it depends on the personal or the proprietor's own reputation that will give them the cost of capital uh, from the banks or any lending agency. So what is the benefits or the consequences of partnership? Partnerships are also easy to set up. So it implies diversified decision making processes, can survive the withdrawal of a partner, because new partner can be adjusted. So profits are taxed only once, but it has the consequence of managerial decision making, because consensus about managerial decision making is difficult, because there are more than one mind or more than a single mind. So it is difficult sometimes. They are not agree on you know they don't agree on something that is not in the favor of the firm. So it is difficult to get the consensus about managerial decision making. So the owner's entire wealth is at risk, and getting capital is expensive. So the third one is corporation. So the benefit of corporation is limited liability. So it is large scale and low cost capital that is readily available. So it has professional management, so they know very well how to manage the corporation or the business. So lower costs from long-term labor contracts. But the problem is the complex management structure can slow the process and a bit expensive, because they need to follow the managerial hierarchy. And another disadvantage is the profits tax twice as corporate profit and shareholders income tax. What is the relative importance of different types and firms? So there are a greater number of proprietorship than other form of business, but corporations account for the majority of revenue received by the businesses. So let's see in our data set. So this shows the number of firms and the number of firms proprietorship. The you know the more number of firms have the proprietorship, and then partnership. This one and the corporation. So if you count the corporations, corporations are uh, quite lesser than the proprietorship. But the distribution of revenue or the distribution of total revenue. So major chunk of revenue goes to corporation and quite meager to number of quite meager to proprietorship. If you see the breakup of different industries, so agriculture, forestry, and fishing, so it is almost equal to the proprietorship with corporation. Services, definitely corporations, more corporations offer services than proprietorship. Construction industry, it is also heavily corporations are higher here. Then retail trade, more cooperation than proprietorship. Mining, mining also cooperation has major share here. But interestingly, here in mining sector, proprietorship or the partnership supersedes the sole proprietorship because I think the cost is important factor here. So the transport and public utilities also corporations are higher than um, partnership and sole proprietorship, then finance, insurance, and real estate, wholesale trade, and manufacturing, which is highest among all.